As a professional trader, I don't treat RSI as a magic signal generator. I treat it as a momentum reading tool. This distinction is critical. Many traders see RSI's 70 and 30 levels on TradingView. They believe it's a simple formula. Act at the upper threshold, engage at the lower threshold. This is exactly why so many traders lose money with RSI. The RSI isn't the problem. Blind interpretation is the true issue. First mistake: treating RSI 70 and 30 as automatic trade signals. In real markets, overbought and oversold can be misleading. Shorting at RSI 70 in a bull market means fighting momentum. Buying RSI 30 in a bear market can be catching a falling knife. Correct mindset. RSI 70 and 30 are attention zones, not trade signals. They tell me to study the chart more carefully, not to enter immediately. I need context, trend direction, price structure, and confirmation. The second common oversight: neglecting the wider perspective, a frequent business challenge. A short-term positive indicator means little if the long-term trend is negative. Institutions may still be selling. Lower time frame is a temporary bounce. I don't automatically buy. Is this a reversal or just a weak bounce? In a bearish trend, buying RSI 30 is usually not the best trade. Wait for RSI to bounce towards 60 or 70 on the lower time frame. Then look for a short setup, aligning with the dominant trend. Professionals use RSI with the trend, not against it, for better results. Third mistake: misusing RSI divergence. It's popular, but often abused. Bearish divergence suggests weakening momentum. It's a warning. Bullish divergence suggests selling pressure is fading. But divergence is a warning, not an entry signal by itself. Many traders immediately open a reversal trade after seeing divergence. This is concerning. A sustained deviation can last for days or even weeks. Price can continue trending while multiple divergences appear. Entering too early means you might lose money due to poor timing. Solution: wait for price action confirmation before taking a trade. The indicator gives me the warning, but the observed movement gives the decisive signal. Fourth mistake: forgetting multi-timeframe analysis is crucial. RSI behaves differently depending on the chosen time frame. A 5-minute RSI signal can be powerful, but it's often just noise. Short time frames are full of manipulation, emotion, and random volatility. Relying only on short time frame RSI means trading noise, not structure. My process starts with the higher time frame first. I look at the daily or 4-hour chart for the dominant direction. Then I focus on a more detailed view for a specific action. A broader perspective gives guidance. Immediate observations give the precise moment. Daily chart bullish, 4-hour making higher highs. I prefer long setups.
I don't panic when RSI hits 70. Strong RSI confirms momentum. I may wait for RSI to pull back toward 40-50 before entering long.
In an uptrend, RSI often finds support around 40 to 50, not 30.
In a downtrend, RSI often fails around 50 to 60, not reaching 70 to 80.
This RSI range behavior is more useful than blindly using 70 and 30. Fifth mistake, using RSI as a standalone tool alone. No professional builds a strategy around only one indicator. RSI measures momentum, but it doesn't tell you everything. RSI should be a filter, not the entire strategy.
Combine RSI with market structure, support, resistance, volume, and candlesticks.
Careful analysis provides impetus. Strategic overview gives direction. Foundational elements define placement, and opportune moments dictate action. Risk management decides if the trade is worth taking. Amateurs seek easy signals and fight trends. Professionals wait for confirmation.
Stop blind use. Trade RSI signals aligned with trend, structure, and risk control.